Assalamu alaikum. Okay, friends. So now we recap the content that we discussed in the last video. That is, what is the allowance method of recording the bad debts, right? So recall we discussed first the direct write-off method, which actually says that when we do not record any adjusting entry towards the end of the period, but during the period, whenever we get confirmed that some account receivable, some party is not going to pay, we get that sort of signals confirmation. Then we record an entry, bad debt expense debit and account receivable credit. So account receivable is reduced, so being credited, and reduction in asset due to doing business is an expense. So owner's equity decreases means owner's equity means expenses debited. Then we discussed the allowance method, which is allowed under the IFRS, whereas the direct write-off method, it is not allowed unless the losses are insignificant. So allowance method, we say that we have to estimate. So so how do we estimate? We have to estimate the cash net realizable value of our account receivable. It means that if my total account receivable are 1 lakh, but maybe the net realizable value means the amount that I estimate that will be collected against 1 lakh is 95,000. So it excludes the amount that the company estimates it will not collect, right? So 5,000 is excluded. So companies must use the allowance method for financial reporting purposes when bad debts are material, significant bad debt. Significant means 1%, even half percent is significant, right? So there is no particular threshold for significance, but you can see this helpful hint probably. So anyway, we are not concerned at this point in time to gauge what is material and what is not, what is significant and what is not. So for at least for the academic purpose, everything that is given is a significant, right? So companies estimate uncollectible account receivable, number one, in the same period in which the revenue is recorded. So if the sales belong to year 2002, accounts receivable have been debited in year 2002, then towards the end of the year 2002, we have to calculate the estimated bad debts against those sales which have been made in this year. So companies debit estimated uncollectibles to bad debt expense or uncollectible expense, and the company's credit to the allowance account. And when we write off a specific account, then what we did, we debit the actual uncollectible to allowance for bad debts accounts, as we saw in the last video. So allowance is debited and receivable is credited. So this is the entry towards the end of the period, right? So this is something that we discussed in the last video as well. And this is how we present account receivable in our balance sheet towards the end of the period. So let's say this is the allowance account has been credited by 12,000. So the bad debt expense will go to the income statement, whereas the allowance account will actually go to the balance sheet. So and it will remain intact with its main asset account. So since it's a contra asset account, so it will remain intact with the account receivable. So it will be shown against account receivable. So account receivable has a debit balance, allowance is a credit balance. So the net account receivable is shown in the balance sheet on the asset side. Now the write-off, when we get confirmed that some customer is actually not going to pay, then we actually transfer the amount which has been parked to the allowance for doubtful accounts or allowance for bad debts to the account receivable account. So now recall that this entry, right, we discussed in the last video, in this entry actual credit should go to account receivable. But we didn't create account receivable because we actually didn't know that which account is going to not pay. So we created a contract account. But now when we get to know which account is actually not going to pay, so there is no need of this account now to the extent of that particular bad debt. So we debit this account, reduce this account, and now we credit account receivable account, right? So this is the write-off entry. It means to maintain segregation of duties, the employees authorized to write off accounts should not have daily responsibilities related to cash or receivable. So this is something related to internal control. So we are not concerned about it for now. So allowance is debited and account receivable is credited, right? So now keep in mind this is not necessarily the amount that was actually estimated, because the estimate was for the whole year, and this entry again is not made at the end of the period. It is made as whenever we come to know. So to illustrate a receivable write-off, assume that the financial vice president of Hampson Furniture authorizes a write-off of 500 balance owed to this customer on March 1. So this authorization has taken place on March 1. Now, what does authorization mean? This means that the president or the CFO or whoever is actually managing these account receivable actually decided that, okay, this customer has now or capacity to pay based on maybe the customer has announced a default, or the customer is dissolved, or the customer disappeared, or anything. So subsequent to that, at some point in time, we decided, okay, we need to remove that account receivable from our books. So we debited the allowance for bad debts accounts and we credited the account receivable account. So now, what is the impact of this entry? Think about it. What is the impact of this entry on my income statement? What is the impact of this entry on my balance sheet total? Just think over it, right? And on the other hand, what is the impact of the direct write-off entry? So sorry, this write-off of receivable entry on my income statement. What is the impact of this entry on my balance sheet total? What is the impact of this entry on my book value or carrying value of accounts receivable? Now, remember the term carrying value or book value means the net value which is shown in the balance sheet, right? So the net value shown in the balance sheet, what is the impact of this entry on the net value of receivables shown in the balance sheet? So just ask these three questions, think over them, reflect over them, and then answer this question in the class, or maybe discuss these questions among yourself. So this is something important, right? We do not debit the bad debt expense again. Rather, we debit the allowance for bad debts, allowance account, whenever we actually write off a receivable. So now you see, one of the question is asked, before write-off, my receivables were 200,000, my allowance was 12,000, so my cash realizable value, net value, book value, carrying value of account receivable was 188,000. After the write-off, my receivable has been reduced by 500, so it is 199,500. My allowance has been reduced by 500, so it's on the credit side, so 11,500, so my net realizable value is 188,000. So you see there is no change in the value of account receivable. There is no impact of this entry on either the income statement, either balance sheet, because the balance sheet will carry the net book value of the asset. So what is actually happening? The contrast that is being transferred to the asset. The contrast that is being set off against the asset value. So there is no net change. Because why there is no net change? Because the bad debt expense was already estimated in the last year. So now this confirmation that one party is going not to pay is not affecting my balance sheet because we have already recorded. So the only thing which is affected is the distribution of balance between receivables and allowance account. So when you will do some practice, maybe 3 or 4 or 5 questions, then you will realize this more. So recovery of an account receivable. So this is equally possible, right? That a customer which has whose balance has been written off subsequently pays the amount. यानी ऐसा हो गया कि हमने तो राइट ऑफ कर दिया था, उसने कह भी दिया था कि जी मैं नहीं दे सकता पैसे, और हमने बहुत फॉलोअप किया, लेकिन फिर उसको खुदा का खौफ आ गया, किसी जगह उसने पढ़ लिया कि अगर इंसान कर्ज की हालत में मर जाए जबकि वो पे कर सकता हो तो आखिरत में इसका बहुत बड़ा हिसाब है। तो उसको जो है वो एहसास हुआ और उसने जो है वो कहा कि सर मैं आपके पैसे दे देता हूँ। तो जैसे ही जिस दिन उसने आके कहा कि मैं आपके पैसे दे देता हूँ, ठीक है, चाहे वो भी उसने दिए नहीं है, लेकिन हमें पता चला कि ही इज़ नाउ गोइंग टू पे, तो उस दिन हम इस वाली एंट्री को रिवर्स कर देंगे, राइट ऑफ वाली एंट्री को पहले रिवर्स करेंगे, ठीक है, यानी हम उसकी अकाउंट रिसीवेबल को दोबारा रिस्टोर करेंगे, क्योंकि ये तो राइट ऑफ था ना, तो राइट ऑफ को रिवर्स ऐसे ही करना है कि इस एंट्री को रिवर्स करना है। तो इस एंट्री को रिवर्स करने के लिए हम पहले एंट्री बनाएंगे, वी विल डेबिट द अकाउंट रिसीवेबल and we will credit the allowance for bad debts account with the same amount which is going to pay. Now this is also equally possible that we written off 500, but he is just paying 200, 300 because he can pay just this amount. So in that case, we will make this entry only by the amount which we know he will pay. So there are 2 or 3 situations. He comes to us, he says that okay, I'm going to pay you full amount, so we will record this entry. He comes to us and says that I will pay you 200 now and then I will pay you 300 sometime in future. Still we make this entry with the full amount, right? Because we know that now he is going to pay. And even if he doesn't pay right now, we will make this entry as soon as we get confirmed that this customer is now going to pay, he is back alive. And now whenever he pays, so that's becomes an accounting entry, cash debit and account receivable credit. So this is something that we have already discussed in chapter 2. So this is the recovery of account receivable. Now think over it, that how this recovery of a bad debt will be recorded under the direct write-off method, right? Although they have not discussed there, so let us see it. right? And if it doesn't make sense, if you are getting confused from what I am talking now, then you have to see these videos multiple times. You have to do some practice, and then you have to revisit these videos. Then it will make sense to you, right? So I can understand that if you are watching all these videos in one go, and the concepts are actually inflating your mind, then probably you won't be able to actually comprehend everything in the one go. So this was the entry under the direct write-off method. Under direct write-off method, we didn't estimate it account receivable, right? Under the direct write-off method, whenever the customer actually came defaulted, we recorded it as an accounting entry as a bad debt expense, not adjusting entry, but rather than journal entry, accounting entry, bad debt expense, debit, receivable credit, no allowance account, right? Now in this case, if the next year the customers come back and give us the full amount, we will just reverse this entry, right? So we'll debit account receivable and credit bad debt expense. Now somebody can ask how an expense can be credited in the next year, because keep in mind this bad debt expense will get closed in the 2022. In the closing entries, this will become zero. And then in the year 2023, when will be debit account receivable and credit bad debt expense, the expense will have a credit balance, right? So how we will take care of the credit balance? So this is also not probably included in your syllabus, but for those of you who are interested to know this, so then we will probably in the year 2023 also there were some bad debts, so we will be recording some debits like this one in 2023 as well. So that credit will be adjusted against those debits, right? And this is equally possible that the net balance is credit. In that case, the net balance credit will go to the income statement with the title recovery of receivables. So you will see in some income statements, right, recovery of receivables, although they do not use the direct write-off method, but over here, right, so come over here. So okay, so this is the allowance method that we actually use under the corporate accounting, under the IFRS principles. So a recap of all the entries under the allowance method. So first of all, the estimate towards the end of the period, bad debt expense debit, allowance for bad debt credit. How do we determine this amount? This is something we are going to cover in the next lecture, in the next video. Then in the next, when actual bad debt is actually actual customer defaults. So it's not going down. I don't know what happened. Okay, sorry. So let's have a recap of. Okay, so this is the entry for recording the bad debt, right? Adjust entry towards the end of the period. This is the entry for recording the write-off, allowance debit, account receivable credit. Of course, amount will be actual amount which a customer confirms that we get confirmed that the customer is not going to pay. And these are the two entries for the recovery. So when we get to know that the customer will pay, we just make this entry, and if the customer pays on the same date, then we make this entry as well. Maybe this entry is made 2nd July, 3rd July, or maybe 1st August, right? So these are the four basic accounting treatments which you need to know under the allowance master. Now in the next videos we will see how to estimate the amount of the allowance, right? Thank you.